Bruce, I have to guess that this is the question that you're all talking about right now in your meetings. Like, how does inflation impact earnings and growth?
It starts with every morning meeting when we get together the traders, the investment managers at Marathon, the analyst team, and we talk about the macro first before we dig in and talk about industries and company-specific news. And so when you talk about the macro and we talk about what we heard yesterday, we heard from the dangerous man. I'll take the other side of that. He's not a dangerous man. He's the man that should really be renominated for another term. And we believe he'll have the votes because we think it's really, truly nonpartisan. There are a couple senators that maybe have a very adamant view otherwise, but we believe he'll get the nod because Janet Yellen and we believe the cabinet is there, and we believe the votes are there. So the first question then is tapering. The Fed buys every month, 120 billion, 80 billion in treasuries, 40 billion in mortgages. That equates to 1.44 trillion per year. So when they taper, and if they begin in November, December, they end by July of next year, then who's going to buy that additional $1.44 trillion in debt? And to underwrite that, does it take a higher interest rate to underwrite that? And the answer to that, I think, is all in inflation. And so if inflation is truly transitory, then I think it could be underwritten well at current rates. But if it proves to be less than transitory, and when does transitory become more permanent is the question, then I think it takes higher rates. And that is something the market hadn't been used to. There's an enormous amount of duration in the marketplace, more duration than has ever existed, more bonds that have ever existed, and investors in the marketplace aren't ready for these losses and higher rates of inflation. So the key here is inflation. And you see it throughout the system. Housing prices, we got the Case-Shiller just recently, yesterday, 19% year over year. You see what's happening in shipping prices. You see what's happening in food prices. You know what it's like to go into a restaurant here in New York City or any city where prices are up 20%. Labor costs are up, and these aren't transitory costs. These, we believe, are somewhat permanent costs.
Oh, yeah, okay, that's a massive issue for a lot of companies that are clinging on, Bruce. So let's talk about the default rates. If we do see these prices being as sticky as you say, do you think companies that are kind of at the margin, that have been supported by the huge amount of largesse that the dangerous man has delivered, do you think that they will be able to survive if we do see input costs rising for many of these businesses? These are the critical costs. You kind of pay your people too much, you're going out of business. Your suppliers charge you too much, you're going out of business. Where do we sit in terms of the default story associated with this inflation narrative?
Well, the default rate has dropped below 2%, and what you're going to see is going to be about 1%. So I wouldn't worry too much at this stage about defaults. Debt-to-EBITDA ratios for the high-yield market has fallen from about 5.3 times to around 4 and change right now, so they've improved. And as equity prices have rallied over the course of the last year or 2 years, the debt-to-enterprise value is also the best it's been in years. And so we believe, as fluid as the markets are, as much capital has been raised, and so you look at the high-yield market, there used to be X number of issuers a year. X was around 150 to 200, and now you have 400 issuers a year. In fact, this calendar year, we talked about the IPO market having record issuance. Also, in the high-yield leveraged loan market, we'll have record issuance, including 75 new issuers. And in fact, I happen to be wearing my Warby Parkers right now. So congratulations to the company on their IPO in your last interview.
We didn't even know it was going to turn into an advertisement. So, okay, last time you were on, specifically we were talking about how you made some investments into the UK hospitality industry, and then a lot has happened since then. And they're actually getting hit more with Brexit issues, labor issues, and power issues. What's it like to do that business now? Would you be investing more? Do you regret the investment?
No, we like the investment. Hospitality is coming back. Our hotels are all improving from the basis which we bought it, and we're acquiring more. The big but, because there is always a big but in everything, is we have 1,800 employees across this enterprise, and we're short about 110 in terms of service. We've hired 325, and so hiring is very much of an issue. And Guy, you live in UK, and you see it. And you see it, throughout all pricing. You can talk about energy, for instance, and what the gas lines look like. Those gas lines is not because we have a shortage of energy. It's because you have a shortage of transportation. There's 18,000 less truckers that work in the UK today versus, pre-COVID, pre-Brexit. And so, when you have, natural gas and oil and gas coming, and that needs to be, going from the ports, to the stations or, to industry, to companies. That's a problem when you don't have the truckers that you once had. And part of that's Brexit, part of that's COVID.
What do you think the gap is between where between supply and demand? How strong do you think demand is, and how big a gap is there? And is that gap getting wider on the supply side?
Yeah, the gap is getting wider on the supply side. The supply is a real issue, and the whole supply chain is what that question begs. And it starts with many different aspects, right? So it starts with shipping costs, and so off the port of Norfolk or Newark, it's a 10-day lag to get your ships to dock, to unload. In Long Beach, California, it's 14 days, and there's 70 ships sitting anchored off of Long Beach. And beyond those 70 ships, what you don't read about, there's another 14 right now that's sitting beyond the waters where you can actually drop an anchor because it's too far out, and so they're kind of just moving around and with the winds. And so, but once you get it to port, then you take the containers off, and then they sit there, and that's why you see that the rail car traffic is down 15% when it should be up 5% because we're moving so much merchandise. And so it's really problematic. You look at the chip shortage, you look at the labor shortage, you look at, the prices that you see for all commodities, whether it's glass and steel and wood and materials and finished goods and appliances. And so you can see why housing prices are up, because the price of labor is up, the price of land is up, the price of everything that goes into constructing a home is up, including, the plumbers, the electricians, but also the materials that go into the home.
Let's switch gears for just a second. Evergrande.
Evergrande.
Does that create opportunities for you, or does it freak you out?
Oh, absolutely opportunities. I mean,
okay. Where? How?
Evergrande. The big picture in Evergrande is it's a problem. It's a problem for China. It's a problem for its housing market. It's a problem for the banks that, and the whole, segment that it kind of like relies on this, right? And so there's a lot of jobs related to this, and a lot of commerce related to this, a lot of industry related to Evergrande. So number one, that's a problem. So here's the pecking order for all the folks that are thinking about Evergrande and think about the logic of how it's going to play out. Number one is the first obligation, when this gets restructured, when that day comes, and we think the can will be kicked down the road a bit, and there will be some coupons maybe to get paid in interim, but when it happens, and we don't know when it happens, the first pecking orders, they're going to make sure that the homeowner that bought those homes take delivery and that they're made whole. Second is the trade, the folks that did the work and that supplied the goods and services and appliances to bathtubs are going to get paid because they're owed a lot of money. Third, and this is very interesting, are the domestic creditors are going to get paid first. And then finally, at the very end of that pecking order are going to be the offshore bondholders, the dollar bonds that trade in New York law outside of China.
Okay.
And there's lots of that debt that's came in domiciled New York law implied.
Right.
And so we're in the marketplace buying Evergrande debt, and we'll continue to buy it at these very low prices. And the whole question is the price of acquisition for the debt that you buy relative to what you think recovery value is. And we don't know what that recovery value is, but you're getting close to the point where we think it now makes sense for the first time. So we never bought the credit until just this week.
25 cents? I'm hearing 35 cents maybe.
25, 30, sold to you, big guy.
Okay, but you so you'd be that's interesting. So less than 25 cents.
Talk about exact entry points, but no, not 30 cents.
No, but I'm curious. I'm curious how if the capital structure looks like it's completely reversed. It would normally be completely the other way around.
Yes.
So basically, what you're saying is that the dollar holders are going to be last in line, and therefore the recovery rates are going to be significantly lower than you would normally expect.
It's completely unknown. What happens in China, what happens in Hong Kong, and this is Hong Kong based, is completely unknown variable, and what we have to watch first.
So, are there other opportunities that Evergrande is also creating? So if you're buying Evergrande debt,
well, they're selling down a lot of
point.
assets, right? So there's just monetized 1.55 billion. And that'll go to pay off a bank, and there's going to be other assets they sell, because in this holdco is a lot of assets, and that includes assets beyond just the property. that they're delivering.
Are there any other developers, Bruce, in China that you think are also going to end up in the same position? Are you buying credit elsewhere?
Well, we think you wait for the domino to actually fall, and you see how bad it gets for others that aren't quite the problem that Evergrande is today. And so there I would be patient. Wouldn't want to be early. And there I would want, proof of concept and, this case study to play out before we would invest more.